Welcome to the Main Street Meets Wall Street podcast, where we bridge the gap between everyday financial realities and the complexities of the global economy. In this special two-part series, we dive deep into the intricacies of the U.S. national debt with our expert guest, James Callahan. In this first part, we explore the staggering figures behind the national debt, understand how it compares to the country's assets, and discuss the implications for both Main Street and Wall Street. James brings his extensive experience as a credit research analyst to help us unravel these complex topics in a way that's both insightful and accessible. Stay tuned for part 2, where we'll continue this enlightening conversation, and we'll cover rating agencies, how debt is rated, and how debt is funded. Now, let's get started with part 1.
Hey everyone, welcome to another Main Street Meets Wall Street conversation. Today I'm sitting down with James Callahan, industry professional, veteran. He knows a lot more about the debt than most people, the deficit than most people. Don't get scared about what we're going to talk about. We're going to talk about debt, the deficit, ratings agencies. How do they come up with these type of things, and then we'll let James give you a little bit about himself and his history. So with that little short intro, we'll just start out with you, James. How are you, James?
Fine, Marcus. Thank you for allowing me to be here. I'll just give everybody a brief background. I spent most of my career as a credit research analyst, approximately 19 years at State Street Global Advisors. The first 8 years were spent on the investment grade credit side, and the remaining 11 were spent on analyzing high yield debt instruments. Prior to that, I worked as a CPA. So glad to be here. Marcus and I sit on an advisory board for Circa Capital LLC, and we were talking about debt, specifically the national debt of the United States, on our last meeting. And so he just thought it would be a good idea to have me on and we could talk about it because it parallels individual debt in terms of it growing astronomically high and the increasing cost to service or to service the debt or pay the interest. And so we just wanted to talk about debt in general, and then I guess dive into different topics that may be of interest. So, the key figure we talked about was the national debt of the United States. It's running currently at about 38.6 trillion. And that's a huge number. And, along with that, that's specifically legal debt obligations of the United States. But along with that, the other unfunded obligations of the United States include Medicare promises, Social Security payments, health and welfare liabilities. And when you look at all of those forms of unfunded liabilities along with the national debt, the latest figure is approximately $164 trillion. And that compares to assets of $5.7 trillion of the United States.
Hold on, James. Can you give me that number one more time? Give me, because I know I hear like 30 some odd million in debt. What did you just say? 100
Yes.
and can you give me that one more time?
Sure, it's 164 trillion in all. That includes, Marcus, what they're including here is unfunded Medicare promises, unfunded Social Security promises, pension and retiree healthcare liabilities, and then other liabilities. And when you look at all those in the aggregate and you add in publicly held debt, now of the national debt, they're including only 28.3 of the 38.6 because that's what's held by individuals. The remaining 8 and change is held by intragovernmental agencies. So it's a significant number. And again, as I mentioned previously, most of this, with the exception of the national debt, the 28 trillion in debt, bonds, notes, treasury securities, et cetera, the bulk of that, it's not legally binding, but those relate to promises made by politicians to pay for these other programs, Medicare, Social Security, into the future. So it's a lot of money, and that's just at the federal level. That doesn't include anything at the state level or local government agency. So it's a significant amount of debt. And I think why it's important to think about this is because when we look at the individual level of debt in this country, the last number I saw was about $18.6 trillion. And that's substantial. And the bulk of that obviously is mortgages, but there's still a lot of credit card debt, auto loan debt, et cetera. And the reason why, when you think about this, the amount to service For instance, on the individual side, the amount of income that people earn that needs to go towards servicing that debt is about 11%. And on the governmental side, to service the national debt, it's 13% and growing. These are not sustainable levels, and they're going to have to be dealt with sooner or later. But that's a very important part of the United States and capital structures for many companies and corporations. So it's important to, get a basic understanding of it and just ask questions about interest rates, credit quality, the ability to service the debt. Really important. I think for both individuals, if you can understand it at the individual level and then apply it at a larger scale level to corporations and the government, I think it becomes easier to understand or to sort of wrap your head around how significant it is.
Gotcha. Yeah, that's a lot. That could be scary to some folks. Some people ignorance is bliss when it comes to those type of things. So if I'm understanding correctly, let me try to break it down in a way that so we could say the national debt, the stuff on the balance sheet, the 28 to 35 trillion, that would be like your household debt, and then this other debt, the Social Security, which that's another thing. I thought all this stuff was already paid for. This other debt you're talking about, I thought that was already funded, right? But that was how it was intended. But this other debt is maybe like buy now and pay later type stuff. Would that be maybe a good analog to that?
Yeah, that's a good analogy. The national debt of, again, 38.6, but we'll call 28.3 of that is publicly held. So the rest held by intergovernmental agencies. So that 28.3 is basically the US's way of funding their budget deficits. The difference between what they take in taxes, the bulk of the revenues of the United States comes from taxes, individual, corporate, etc. And when you take the income that the United States generates and then you compare that to the spending that the US does, there's a shortfall. And since the pandemic in 2020 and the elevated spending that the US has done to sort of combat the effects of the pandemic, the deficits have been running around 2 trillion, one and a half to $2 trillion, meaning that the amount of money it takes in via taxes and other sources is not sufficient to pay for the programs that it does, 60% of which are non-discretionary and like Social Security, Medicare, et cetera. So that has to be done. But that shortfall between the revenue the revenue the government takes in via taxes less its spending requirements is insufficient. So what they have to do is they have to go out and issue debt, treasury bills, treasury notes, treasury bonds to try to make up for that shortfall. And each year that happens, each year where our spending exceeds our revenues, it continues to add to that deficit and it's growing larger and larger. And one of the consequences of that is, that increases interest costs to carry and service that debt. So that becomes a bigger part of the budget. So, when you look at, say, an individual who has a substantial credit card bill, maybe it's so large that the interest that they're paying on that, they can only afford to make the interest payments. They're not afford to address the principal. So the more that they're unable to pay, the principal remains unpaid and all they're paying is interest cost. And it eats up a big part of their income. And, they could be doing other things with that, making other investments, buying or spending on other items. And so that could potentially have negative impacts on the economy, their failure to spend in areas where they would like to, home purchases, car purchases, etc. So servicing debt is becoming a larger and more important issue. And in the case of the U.S., we talk about in the credit space, we talk about potential default scenarios. A default is when a company that issues debt is unable to pay the debt service, the interest, or the principal itself. And that's problematic because many people lose in that case. And the U.S.'s level of debt is growing large, as is its debt service requirements. And so that is going to be a problem if it's not addressed down the, soon. And yeah, it's a very, very big issue.
Yeah, that's a huge one. So, and with the debt and deficit, so all debts and all deficits aren't necessarily bad, correct? It's like more so the level. Like if I go see my barber, there's going to be a deficit there because I've never cut his hair. He's always cut mine, right? But they're not all the same, but I know there used to be a level, what somewhere around 90%. There used to be like the debt to GDP ratio. Are you familiar with that? And like, where do you think we are now? I've heard it's well over 100%. Like, how does that
So our
interplay in us?
Yeah, so when the latest figure that I looked at, again, the United States fiscal year runs from October 1st to September 30th. So we're in the 2026 fiscal year, which will end on September 30th, 2026. So, these figures are constantly moving and they're changing because of the magnitude of them and the fact that they're not static. So when we look at the most recent GDP figure for the United States, that's the output of goods and services, it's about 30 trillion. And the national debt is running about 120% of that right now. If we use approximately the 38.6 trillion, it's not going to be accurate. Again, these figures are moving all around. So I'm just trying to use a big picture. But debt to GDP at 120% is extremely high and potentially problematic. And we'll sort of go off track here and we'll just talk about the ratings agencies that rate the debt of the United States. So the United States used to have pristine debt ratings, which were AAA across the board. And I'll cite Moody's, S&P, and Fitch. They're the three main ratings agencies that operate in the United States, and they do globally, but in terms of rating the debt of the U.S. The U.S. at below AAA is the main reasons why that triggered ratings downgrades from the ratings agencies were they were concerned about the sustainability of the debt levels. They were also concerned about they looked out the fiscal situation, they didn't see things getting better, or they didn't see solutions being put forth. And they also talked about the political instability in terms of the two sides in Congress being able to sit down and address these items in an amicable manner and reaching good solutions. So when you see a country coming off a ratings downgrade, that's potentially problematic because typically that tells you that now there's a higher level. Again, we're still AA, which is very, very solid, but it's not AAA. And so as you go down the ratings charts, the lower the ratings, typically, the higher the interest cost or the cost to service debt. So if we looked at there are two companies in the U.S. that have AAA ratings across the board. They're Microsoft and Johnson & Johnson. These two companies have strong balance sheets. They can issue debt at very low costs, and that's a big benefit. And so there's a reason why you want to have the strongest ratings. You want to have people confident in your ability to service your debt. When you issue, there'll be strong demand. People are comfortable loaning to you or purchasing your debt instruments, and they can look at those ratings to know that historically you've never defaulted and you're a very strong credit. Same thing in the corporate space, same thing with individuals, right? We have Equifax, TransUnion, and Experian, right? They're the ratings agencies that look at the FICO scores for individual borrowers. And for someone with a very strong credit score, say in the mid 600s to 800 category, it means you're going to be paying, for your mortgage, you're going to get a lower rate. For your car loan, if you decide to get a car loan, whatever you decide to do, credit card, etc., it's going to cost you less to borrow. So the stronger you are personally, corporately, governmentally, the easier it is for you to borrow and to get an interest rate that's going to be favorable and conducive to you to be able to service it. So all around, individuals like corporations, like governments, you want a strong balance sheet because you don't want a ton of debt. Or if you do have debt, it's very important that you have the resources, income from job or assets that generate income to be able to service it. And you want to cover that very, very strongly, meaning, you have the assets or the resources. It's not like if you have a mortgage payment, say that's $1,000 per month, and maybe your net take home per month is $1,300. You have a $300 differential, and maybe you have to use that $300 for food costs, for gasoline, whatever the case may be. If you run into a problem or see a shrinkage in your income or something happens, now to service that debt, that mortgage payment, whatever it is, the liability is going to be that much more difficult and potentially put you in a situation where you have to default or, you lose something, your house or your home or something gets your car gets taken away or repossessed. So like having a real strong balance sheet and being focused on the amount of debt that you can take on and service is really, really critical.
Yeah, knowing where you're at, knowing what you have, that's very important. And like you said, more importantly, knowing what you can spend. I think I saw a figure recently that said that Americans right now are like at over 50% of their income for their housing and total housing expense. And that's just way too high. Like you said, if you have something pop up, you don't have the margins to take care of these types of things that just pop up into your everyday life because it's not if, it's when, right? Something's going to happen. There's going to be an event that happens. And that's so I guess that's just kind of like why countries like the US would have got downgraded. I mean, we have and this is a question, James. We have the reserve currency. I guess we had a reserve currency, right? Ever since we
Right.
went all this changed when we went back off of the gold standard, right? But as of recently, we see that gold has become the number one reserve currency in the world, and we see the U.S. have a downgrade rating, right, in their from AAA down to AA, or AA down to no, it's AAA down to AA, I believe. So
SGS AAA down to AA.
in
And
your
that
days working, James, how would you, if you were sitting in a situation, how would you come to this if you were rating it and analyzing it, the U.S. as we are right now?
it's very difficult because of the US's track record and its ability to service debt. It's never defaulted, and it's got the strongest economy for now. These are things that are very important. The US is, dominates when it comes to equity markets. I think we're 50% of the global equity markets. I would be challenged to stick with the double A. Again, though, I analyzed corporate debt, and there was a difference between investment grade and high yield. High yield, another name for high yield was junk bonds
Mhm.
back when the industry was first created. And so the quality of the assets, the quality of the businesses were not as strong. They obviously had lower ratings and therefore much higher interest rate costs. But, again, it would be hard for me to say, while the United States looking at everything, the double A is appropriate. I'm concerned about a number of things. And if I look at the country like I did a corporate debt instrument, especially the levels of debt relative to GDP, I'd be very, very concerned. And it would be hard for me to justify the double A ratings across the board. Now, S&P was the first one to downgrade of the three major rating agencies. S&P was the first one to downgrade the debt of the United States from AAA to AA plus back in 2011. And the other two, Fitch and Moody's, didn't do so until 2023 and 2025, respectively. And again, Marcus, the reasons why they did that, they cited big picture, rising debt, fiscal projections, and the political factors that we talked about a few moments ago. Those are very concerning. I think because of the U.S.'s history and again its economic position, it probably garners a level of favoritism from the ratings agencies that would be hard to justify for a corporation. I'll just leave it at that. But it's has to be addressed. So when we see things in the press about interest rates and the Federal Open Market Committee and the meeting, it's really important. And even though it doesn't sound like a lot when they talk about a 25 basis point rate cut, or it's very meaningful when you consider it against the amount of debt that the U.S. has. Very, very important. And Marcus, I'd just like to back up just so your listeners have an idea. When we talk about interest rates, right, the Fed, we're talking about the federal funds rate. And that's the rate that member banks charge each other for overnight loans to meet their reserve requirements. And that's the cornerstone of the U.S. monetary policy and key driver in terms of economic activity. The thing swings off of that. So we know this past meeting, the Fed held constant. They didn't change it. They've got a Fed funds target rate of 3.5 to 3.75. And the next meeting will take place in March. But quarter basis point increase, decrease in either direction, huge ramifications again against that national debt. Now, we're not talking about refinancing all that debt because it comes due in stages, right? I think a third of the national debt is up for matures and it will need to be rolled over in 2026. That's a huge amount. And for the United States to be able to roll that over at potentially a cheaper rate goes a long way towards reducing the amount of debt service and reducing the amount expended for that, and helps with that deficit situation. So we've talked about a lot of things, and I hope I'm not going too far off track.
No, it's perfect.
Yeah, really important, because that Fed funds rate, everything keys from that. The rates that we pay for, mortgages, which keys to the 10-year, but again, everything keys off the Fed funds rate, credit card payments, loans. So it's all important. It's all part of, it's all part of what consumers deal with.
Right, because I mean, you can't figure out how much someone can pay back if you don't understand the rate they're already paying on their interest and the direction of interest rates, right? If the interest rates are projected to go up in the country and it's going to cost them more money to service their debt. When we say money to service debt, and when James was saying that it comes due every couple of years, it's because this is like paper money, like short-term treasuries that he's referring to when he's saying this debt. So it's not like actual physical dollars, commercial paper, I guess is a better way of saying it, short-term money, taking bags of dollars overseas when we service this debt. It's actually like a more of a balance sheet transfer, debit and credit,
Well,
on the
yeah,
balance sheet.
but for those buyers, and again, so the big buyers of U.S. Treasuries, foreign buyers, are Japan, China, and the UK. So anyone who buys a Treasury bill, which is short term, Treasury notes, which are 2 to 10 years, and then bonds, which are greater than 10 years, they have to be paid that interest. So the government does pay that interest when it's due. With bills, you pay a discounted amount and you get the full amount back. So you buy in Treasury bills, you'll pay less than $1 million, but you'll get $1 million back, and that differential will equate to the interest earned. On notes and bonds, there's a stated interest rate that you'll collect twice a year and to be paid out. And then when the instrument matures at maturity, you have to get paid back your principal. Those are monies that are important. And again, it's borrowing. A lot of people use the investment word with fixed income instruments or credit, like bonds and notes. But in effect, you're really loaning the government or corporation that money, because they're legally obligated to pay you back and to pay you interest based upon the terms of the debt, the covenant package, the whole bit. These are things that are specific to bonds and notes. So yeah, it's just like you or I, Marcus. Like, we got a car loan, the mortgage, you got to pay that each month. You're writing a check, and a portion of the mortgage is principal and a portion is interest. So, to your earlier point, you made a great point in talking about not all debt is bad. No, when it's utilized usefully in a manner that can be handled properly, I think it can be very good. It can be like, for a mortgage, a sort of forced savings, right? Because each month you make that payment and pay down the principal, you're building equity in your home. And for most consumers, mortgage interest is deducted in their tax returns. So that can be extremely beneficial. The problem arises when maybe you've on too much debt, or something happens, you didn't look at the numbers, or you have a shortfall in your resources to service that debt or repay, and then it becomes problematic. But for most people, it can be a great tool to build wealth and equity, and really beneficial. It's important. One other thing we should talk about, that the debt or credit markets are larger than the equity markets in the United States, and also the same on the global level. So equity markets are huge, and we think about that, but the debt markets are larger at both levels. So extremely important, and,
Yeah, and some
key
of the
part of our economy.
Yeah, exactly. Some of the biggest moves we saw last year, I don't think people realize, like in the stock equity market, was when the actual bond market started to shake, like through February and right through April. Like the bond market started to move, and that's when people were like, "Oh, we might have done a little bit too much in the economic detox. We need to get clearer with our message," because that's part of letting people think that you can serve your debt, or your debt, is if you can explain how you're going to get to this number. With the U.S. right now, we're going through this economic detox, and one of the big things I think that with America, we have two camps anyway. This isn't what we're doing on this podcast. We're not going for one way or the other. We're talking straight facts. One viewpoint is that you can grow out of this debt, right? You can grow out of this
Right.
deficit, maybe inflate away the debt. What could you maybe expand on that a little bit?
Yeah. So the thing about debt, right, is we talk about inflation. If inflation can erode the value of debt, say if I buy a bond, I spend, just say, for instance, example, I buy $1,000 bond, 5-year bond. Well, in 5 years, if we have inflation that's running pretty hot, when I get my money back, because I only get my principal back, I get interest and principal, right? Because again, the best you can do with a bond is to get your money back. In some cases, I don't want to go off course. There are ways you can make more above par, et cetera, but we'll just keep it simple. So inflation, if it's running, 2% a year after 5 years, that's 10%. So now when you get your principal back, the value of that is 90% of what it was. And if inflation runs hotter, then the value of that dollar will erode even further. Think about it. If I have $1,000 now, I can probably buy a lot more now than 5 years from now with that same thousand, all else being equal. Erosion and inflation, it can really, really hurt bondholders. Now, from someone who's paying or borrowing that money, if I want to pay it back, like if I bought a house and have a mortgage, I sort of like that because each year I'm earning more money and I'm paying back in weaker dollars. So I'm building equity faster, and the value of the loan that I borrowed is going down, declining pretty quickly. That's what they mean about, inflating away debt. If inflation starts to get really out of hand, the value of that debt, it just takes less and less to pay it back. So inflation, obviously problematic from a consumer's point of view because you're paying more for goods and services. But that's when you apply it to debt, that's what it means. You're going to get more hurt from an investor standpoint. So those people that, like, I'm trying to think of an example, right? Marcus, someone who's reliant upon fixed income, maybe they have a bonds. They don't have any equity because they're older. Maybe they're retired for a period of time. They're
Social
relying,
Security.
right. Social Security has, CPI increases, et cetera. But if I just had bonds and I'm relying on the interest income, well, now the value of that dollar is cheaper. So my level of living has gone down because I'm getting money in interest payments that's worth less. And when I collect my money, when I get the principal repaid, it's worth much less. So I may not have the same level or standard of living that I did, when inflation ran lower. So that's potentially a problem. There are so many things that stem from inflation on both sides, but it's impactful, and probably more so for consumers on that side. There are some benefits again to paying back a mortgage. It all depends upon if you're receiving, if your wages from your job are keeping pace with inflation, et cetera. Essentially with inflation and debt, if you own debt or buy bonds, it hurts you because the money you're receiving in terms of debt service, coupon payments, and then when you get your principal back, is the value has declined.
Got you. And just for folks who know, when you say coupon, the reason they call it coupon is because you literally used to get a book with coupons that you can
Yes,
like mail in or get your money back for. So that's the coupon. Um, Very fascinating, James. So we're looking at both sides, all sides of this conversation. I'll tell you some conversations or some things I've had some of my clients ask me before. And this
sure.
is, the U.S. is the reason only the dollar, the only safe alternative, only safe investment because there is no alternative. And if the world happened to move away from de-dollarization, like how fast do you think that would happen and how detrimental do you think that would be to the economy? I told them guns and butter if we get to that point in the flash. So like,
Yeah.
I don't see it coming, but
It's a concern, Marcus. I'm not an economist. It's harder for me to give you a good answer here, because during my lifetime, the U.S. has been the strongest economy and the number one reserve currency held by foreign governments. So the value of the dollar was high. Our interest rate policies were strong. Higher interest rates and more solidly based interest rates without runaway inflation will make the value of the currency stronger, because if I can borrow in, say, yen, which is low interest rate, and invest in the US at a higher rate, it makes that demand for US dollar from other countries that much stronger. But we're starting to see where, again, you mentioned we went off the gold standard, Bretton Woods, in the 70s. So the value of the dollar was based on the scarcity. But when we started pumping dollars into the system post pandemic, you increase the volume of the US dollar, and which saw the value decline because now there's so much of it, and hence this sort of benefited the belief that we need crypto, something that was free from central bank intervention and influence. But I, think it's important that the U.S. to maintain its economic status have a strong currency. If it's the number one currency, that just it identifies that the U.S. is an economic engine and powerful.
Thank you for joining us on this episode of Main Street Meets Wall Street podcast. We hope you found our discussion with James Callahan insightful and thought-provoking. This was just the beginning of our deep dive into the complexities of the U.S. national debt. Be sure to tune in for part 2, where we'll continue to explore these critical issues and their impact on both Main Street and Wall Street. You will not want to miss the valuable insights and practical advice that James has to offer. If you enjoyed this episode, don't forget to subscribe to our podcast for more engaging conversations and analysis. And for those of you who want to stay informed with the latest financial news and trends, consider subscribing to the Wall Street South Journal newsletter. It's a great resource for keeping up with the ever-changing economic landscape. Thanks again for listening, and we'll see you in the next episode.